It happens fast, faster than you think. On Tuesday morning, the access card stops working at the elevator bank in the downtown office tower. By Wednesday afternoon, the call is made to the mortgage broker, a voice trembling with a mix of arrogance and terror. By Friday, the sign is on the lawn. But it's not just any sign, and it's not just any lawn. We are talking about the manicured lawns of Oakville, the gated driveways of King City, the ocean view terraces of West Vancouver. The sign on the lawn isn't testing the market. It isn't looking for top dollar. It is a desperate, silent scream for liquidity. It is a white flag of surrender raised by the very people who used to run the Canadian economy. Welcome back to Canada Property Watch. Yesterday, we exposed the white-collar purge, the mass layoffs sweeping through the banking, tech, and consulting sectors. We told you that the high-income earners were losing their jobs. Today, we are watching the inevitable second act of that tragedy. We are witnessing the beginning of the great luxury liquidation. For years, the mainstream media told you that the luxury market was bulletproof. They told you that rich people don't sell in a panic. They told you that high-end real estate was a safe haven, immune to the struggles of the average Canadian. That was a lie. The truth is, the rich are the first to sell when the tide turns, and right now they are rushing for the exits in a stampede that is about to crash the value of every single home in this country. In this deep dive investigation, we are going to analyze the fire sale dynamics exploding across Canada's wealthiest neighborhoods. We are going to explain why banker homes, those custom-built monuments to excess, are flooding the market at 50% discounts. We will expose the private lending nightmare that is forcing immediate foreclosures. And we will explain why this crash at the top is going to crush the price of your townhouse at the bottom. If you thought the housing correction was over, look at the panic in the eyes of the millionaires. The fire sale has just begun. To understand why this is happening, you have to understand the psychology of the distressed, sophisticated seller. This is not your average homeowner. The average family, when they face financial trouble, will hold on. They will go into denial. They will cut back on groceries, cancel vacations, and borrow from family to pay the mortgage. They have an emotional attachment to the home. And they will wait 6 months, 12 months, hoping the market turns around. They are the lagging indicator. The banker, the executive, the tech founder, they are different. They are financially literate. They understand the concept of net present value. They understand opportunity cost. When a banker loses their $300,000 job, they run the math instantly. They look at their $2.5 million home with its $1.8 million mortgage. They look at the $12,000 monthly burn rate to keep the lights on, the pool heated, and the property taxes paid. They look at their severance package, which buys them maybe 3 or 4 months of runway, and they realize the ship is sinking. They know that in a recession, luxury assets go to zero liquidity first. They know that if they wait 6 months and the price drops another 10%, and just they will be underwater. They will walk away with nothing. But if they sell today, even at a massive discount, they might salvage $200,000 of equity to start over. So, they don't wait. They panic first. In the financial world, there is a saying, the first loss is the best loss. This is why we are seeing listings hit the market in places like Rosedale and Forest Hill that are undercutting the competition by hundreds of thousands of dollars overnight. These sellers aren't trying to make a profit. They are trying to survive. They are racing against the foreclosure clock, and they are willing to burn the market down to get out. But here's the problem. They are all running for the same door at the same time. As we discussed in our previous video, the white-collar purge is not an isolated event. It is a sector-wide synchronized event. And thousands of professionals in the same income bracket, living in the same postal codes, are being let go simultaneously. They all bought their homes in the same bubble years, 2020, 2021, 2022. They all have the same massive variable rate mortgages. And now, they all have the same for sale sign. Inventory in the $2 million plus segment is spiking vertically. In some areas of the GTA, Greater Toronto Area, luxury inventory is up 80% year over year. The supply is flooding in. But who is the buyer? This is the fatal flaw in the Canadian luxury market. It was a market built on a greater fool theory that relied on 3 specific groups of buyers: other bankers, speculators, and foreign investors. Today, in February 2026, all three of those groups have vanished. The other bankers are fired or terrified of being fired. They aren't upgrading to a bigger house. They are downsizing to protect cash. The speculators are bankrupt. The assignment market has collapsed. The idea that you can buy a luxury home and flip it for a $500,000 profit in 6 months is a distant memory. And the foreign investors, they are gone. We have to talk about the China shock. For a decade, massive capital outflows from China fueled the high-end markets in Vancouver and Toronto, but that tap has been turned off. China is facing its own deflationary depression. Their real estate market has imploded. The government in Beijing has tightened capital controls to draconian levels. The money isn't getting out. The whales who used to buy sight unseen are not coming to save the Canadian market. So, you have a massive surge in desperate supply meeting a total vacuum of demand. Now, Economics 101 dictates the outcome, a vertical price crash. This creates what we call a price discovery shock. Imagine you live on a prestigious street in Oakville. You think your house is worth $2.8 million because your neighbor sold for that much in 2022. You feel rich. You have a HELOC based on that value. Suddenly, the banker across the street, the one who just got laid off from RBC, lists his identical house for $2.2 million. He needs a quick sale. He gets no offers. 2 weeks later, he drops to $1.9 million. Finally, he sells for $1.85 million. In that single transaction, he has nuked the value of every home on the street. The comparable sale, the comp, has been reset. Your house is no longer worth $2.8 million. It is now worth $1.85 million. You just lost $1 million of net worth because your neighbor panicked. And if you have a HELOC, the bank's algorithm sees that sale instantly. As we warned you in our HELOC recall video, this is the trigger. The bank realizes your collateral has evaporated. They freeze your line of credit. Now you are in financial distress. Now you might have to sell. Then this is the domino effect. One fire sale triggers a margin call for the neighbors, which triggers more fire sales. It is a self-reinforcing downward spiral. Now, let's look closer at the assets themselves. What exactly is a banker home? These are custom luxury properties. They are not commodities. When you buy a standard 3-bedroom townhouse, it's a commodity. It's easy to value, easy to rent, easy to sell. But when you buy a $4 million custom home in King City, you are buying someone else's ego. You are paying for the imported Italian marble they chose. You are paying for the wine cellar they wanted. You are paying for the backyard oasis with the waterfall. In a boom, buyers pay a premium for ego. They pay for the status. In a bust, buyers value ego at 0. The buyer in 2026 walks into that mansion and says, I don't care about your $200,000 kitchen. I don't care about your heated driveway. I am buying the square footage. I am buying the shelter. The premium for luxury evaporates instantly. We are seeing homes that cost $450 per square foot to build selling for $300 per square foot. They are selling below replacement cost. The market is saying that the luxury component is worthless. It is a liability. Why is it a liability? Because luxury homes are money pits. They have high property taxes. They cost thousands a month to heat and cool. The maintenance on the pool, the landscaping, the smart home systems, it is a constant cash drain. In a recession, nobody wants to inherit someone else's burn rate. We also need to shine a light on the darkest corner of this market, the private lending disaster. Many of these wealthy homeowners didn't just use traditional bank mortgages to buy these mansions or to renovate them or to fund their lifestyle when interest rates rose. They took out second mortgages from private lenders. These are not loans from TD or Scotia. These are loans from Mike, mortgage investment corporations, or private individuals. The interest rates on these loans are 12% to 15%. The terms are usually short, 1 year. Those loans are renewing now. The private lenders are not stupid. They see the prices crashing. They see the borrowers losing their jobs. They want their money back. They are issuing demands for payment. They are refusing to renew the loans. The homeowner is trapped. They can't refinance with a bank because they have no income. They can't pay off the private lender because they have no cash. So, the private lender initiates power of sale. Private lenders are ruthless. A bank might wait 6 months to foreclose because they worry about their reputation. A private lender will wait 6 days. They want to liquidate the asset immediately to recover their capital before the market drops further. This is why you are seeing power of sale listings that was wrong. The photos show empty rooms. Sometimes they show damage where the owner stripped the expensive light fixtures or appliances before running away. These are chaotic, messy exits. When a property is sold under power of sale, the lender has a legal obligation to get fair market value. But their definition of fair market value is, what can we get in 30 days? They price it to move. They accept the first clean offer. This aggressive dumping of inventory is shattering the bid-ask spread. For the last year, there was a standoff. Sellers wanted 2022 prices. Buyers wanted 2026 prices. There was a gap of $500,000. No transactions happened. The market was frozen. Now, the fire sales are bridging that gap. The sellers are capitulating. They are crossing the line to meet the buyers at the bottom. The standoff is over. The crash is here. So, why should you care if you don't own a mansion? Why does it matter to the average Canadian watching this channel who owns a condo or a standard detached home? Because real estate is a waterfall. What happens at the top cascades down to the bottom. It compresses the entire property ladder. Think about it. If the $2.5 million homes crash to $1.8 million, suddenly the people who were looking at $1.8 million homes have a choice. They can buy the standard home, or they can buy the luxury mansion for the same price. They choose the mansion. This sucks the demand away from the $1.8 million segment. So, the $1.8 million homes have to drop to $1.4 million to stay competitive. Then the $1.4 million homes drop to $1 million. And the $1 million homes drop to $700,000. The luxury crash sets the ceiling for the market. If the ceiling comes crashing down, the floor has to lower. You cannot have a market where a townhouse costs the same as a mansion. The compression is mathematical and inevitable. Furthermore, this destroys the wealth effect psychology. Real estate is driven by sentiment. When the average person sees headlines about mansions selling for 50% off, or sees the power of sale sign on the biggest house in the neighborhood, they get scared. The person thinking of upgrading from a condo decides to wait. The first-time buyer decides to rent for another year. The volume freezes across the board. The panic at the top kills the confidence at the bottom. We are also seeing the impact of the 2026 tax trap we mentioned in our news update. The capital gains inclusion rate increase has made investment properties less attractive. But for these luxury homes, many of them are primary residences, so they are tax exempt. However, the buyers are often investors looking for a deal, and investors are subject to the tax. So the buyer pool is shrunk even further by government policy. Now, let's address the elephant in the room. Is this a buying opportunity? Is this the fire sale of a lifetime? I know some of you are sitting on cash, looking at these listings, salivating. You see a house that was listed for $4 million now selling for $2 million. You think, I can buy a dream home for 50 cents on the dollar. Be very, very careful. We call this catching a falling knife. Just because a house was listed for $4 million does not mean it was ever worth $4 million. That was a fantasy price. That was a bubble price. If it drops to $2 million, it might still be overpriced. The fundamental value based on rental income or replacement cost might only be $1.5 million. If you buy now, you are stepping in front of a freight train. You are buying an asset that is still depreciating. You are buying a money pit with a $20,000 annual property tax bill and a $1,000 monthly heating bill. And remember, you are buying in a neighborhood where your neighbors are all distressed. What happens when the guy next door sells for $1.5 million next month? Your equity is gone again. The banks know this. That is why they are rejecting mortgages on these properties even for qualified buyers. We are hearing reports of bank appraisers coming in aggressively low. You offer $2 million. The bank sends an appraiser. The appraiser looks at the fire sales on the street and says, "Sorry, the risk is too high. We value this at $1.7 million. The deal falls through. The seller gets more desperate. The price drops again. This is the liquidity trap. The banks are de-risking the luxury sector entirely. They don't want these assets on their books. So, what is the end game for the banker home? We are likely to see a massive transfer of wealth, but not to you and me. We will see vulture funds and private equity firms stepping in. They will buy these properties in bulk from the lenders for pennies on the dollar. They will turn them into high-end rentals, or they will sit on them for 10 years until the next cycle. The Canadian dream of climbing the property ladder to the big house on the hill is being dismantled. The ladder is broken. The big house is a foreclosure. The people selling these homes are not villains. They are people who played the game by the rules of the last decade. They got the good job, they got the big mortgage, they bought the status symbol. They believe the lie that real estate never goes down. Now, they are the victims of a paradigm shift. The economy has moved from asset inflation to asset deflation. And leverage, which works like magic on the way up, works like a guillotine on the way down. The for sale sign on the lawn is not just a real estate listing. It is a monument to a failed era. It is the debris of the cheap money bubble. If you are a seller in this market, you have my sympathy, but you need to hear the truth. Chase the market down. Don't price your home based on what you want. Price it based on what you need to get out. The first price cut is the cheapest. If you wait, you will be chasing the market all the way to the bottom. If you are a buyer, patience is your weapon. The inventory is building. The desperation is rising. The fire sale has just started. The flames haven't even reached the hottest point yet. Wait for the panic to turn into despair. That is when the real prices emerge. We are watching the total repricing of the Canadian dream. The facade of wealth is crumbling, revealing the debt and the insolvency underneath. Do not be lured by the 50% off sticker. In a fire sale, the only winner is the one who holds the cash and waits for the ashes to cool. We will continue to track the specific neighborhoods seeing the biggest price drops. In our membership section, we are posting a list of the top 10 crash zones in the GTA and Vancouver, neighborhoods where inventory has doubled in the last 30 days. Join us there if you want the raw data. Subscribe to Canada Property Watch. We tell you what the real estate agents won't. The bubble has burst at the top. Get out of the way of the waterfall. Stay liquid, stay patient, and don't catch the falling knife.